10th March, a relatively lesser-known California bank became the center of attention in the markets. Founded in 1983 in North California's Tech Corridor, Silicon Valley Bank rose over the decades to become the premier financial institution for technology and health startup businesses in the United States. Driven by rapid growth during the COVID-19 pandemic, the bank had over $200 billion in assets as of the end of 2022. However, on that fateful day, the bank's shares plummeted by 86%, and customers rushed to the bank to withdraw their deposits, forcing the company to suspend trading. The stock price crash also affected some of the biggest names in the US banking, including JP Morgan and Bank of America. So what caused the sudden collapse? There were two factors involved, both linked to the US Federal Reserve's aggressive interest rate hikes as a part of its efforts to curb inflation. Firstly, the Fed's tightening campaign had a negative impact on SVB's bond holdings, and it revealed a $1.8 billion loss after completing a $21 billion fire sale of its fixed income portfolio. The bank attempted to raise $2.3 billion through stock sales to cover these losses but was unsuccessful. Secondly, due to the higher cost of borrowing, startups found it more challenging to access funding, resulting in a high level of deposit outflows from SVB. This sparked concerns of a bank run, causing several of SVB's clients to limit their exposure to the institution. According to analysts, SVB's unique niche in the tech world is a real boon when the business is booming, but a problem when it's not. At the time of its collapse, SVB was the 16th largest bank in the US. So what happens to the customers now? Although the US Treasury Secretary Janet Yellen ruled out a government bailout for SVB, she assured that they would step in to protect all depositors. Head to business-standard.com for more news, views, and insights.